Welcome to today's video on bonds. Bonds are a type of investment where an investor loans money to an organization or government for a fixed period of time. In return, the borrower promises to pay back the borrowed amount with interest at a specified rate. In this discussion, we will be exploring what bonds are, how to invest in them, how they work with an example, their foreign market, their positives and negatives points, and how they are more effective than shares. Investing in bonds requires an investor to have some knowledge of how they work. Bonds can be issued by governments, municipalities, corporations, and other entities to raise money for a variety of purposes. When an investor buys a bond, they are essentially lending money to the issuer for a set period of time. In return, the issuer pays the investor interest on a regular basis until the bond's maturity date, when the investor receives their principal back. To invest in bonds, investors can either purchase individual bonds or invest in bond funds. Individual bonds are purchased through a brokerage firm, financial advisor, or directly from the issuer. Bond funds, on the other hand, are mutual funds that invest in a variety of bonds. This provides investors with diversification, as the fund manager invests in a variety of bonds with different maturities and credit ratings. Let's look at an example to understand how bonds work. Suppose an investor purchases a bond with a face value of $1,000 and a coupon rate of 5%. This means the issuer will pay the investor $50 in interest each year until the bond matures. If the bond has a maturity date of 10 years, the investor will receive $50 in interest for 10 years and then their $1,000 principal back when the bond matures. Bonds are also available in foreign markets. Investing in foreign bonds can provide diversification benefits and access to higher yields than domestic bonds. However, investing in foreign bonds also carries additional risks such as currency risk and political risk. Positives of investing in bonds include stability, predictable income, and diversification. Negatives include lower returns compared to stocks, interest rate risk, and credit risk. Bonds can be more effective than shares in certain situations, such as when an investor seeks to preserve capital or generate a predictable income stream. In conclusion, bonds are an investment option where an investor loans money to an organization or government for a fixed period of time. Investors can invest in individual bonds or bond funds and can also invest in foreign bonds. While bonds offer stability, predictable income, and diversification, they also carry risks such as lower returns and interest rate and credit risks. Bonds can be more effective than shares in certain situations, and investors should carefully consider their investment goals and risk tolerance before investing in bonds.